Hello, and welcome to One-to-One Mining Investment APAC Online. Today, we're pleased to welcome Andrew Batson of Gavekal Dragonomics, who will give us insight into the risks to China's recovery post-COVID.
All right, thanks for having me, Amy. Today I'm going to go through some slides to give you all my assessment of where China stands in its recovery from the pandemic. So as we know, China was the first country to go into a lockdown to stop COVID-19, and was also the first country to come out of a lockdown, now being joined by many others. So I think the right place to start is just to look quickly at what the numbers are telling us about the epidemic situation in China. So basically how are things going on the ground there? So the worst of the outbreak in China was over by early March, and the authorities started to loosen some of the lockdown then. Shortly afterwards, though, there was a rebound in cases, a lot of them from people traveling back into China. So we saw a rebound in case numbers in late March and mid-April. In response, the Chinese authorities had to tighten things up again. But as of the end of April, the new case numbers have really slowed down to a trickle. And by early May, the central government made an important declaration. They said that basically all stores, restaurants, hotels, recreational facilities across the entire country can reopen as long as they observe health precautions. They're still keeping a close eye on things. There was a small outbreak in the northeastern province of Jilin early in May. The numbers there were not large at all, but the measures that were taken were very strict. So there's no sign that particular outbreak is getting out of control, but it was a signal, I think, that the government's really taking a zero tolerance approach toward the coronavirus, and they want to nip even the smallest rebound in the bud. One thing that the government is closely monitoring is the number of asymptomatic cases, since these pose a greater risk of spreading infection undetected. It's worth noting that China is one of the only countries that has the testing capacity to even test for asymptomatic cases. These numbers have started to pick up a bit more recently, so that's something worth keeping an eye on, although again, the size is still pretty small. I do think, though, that even if there is a need to reimpose lockdown type measures in the future, that's going to be very localized and very targeted. It's done on a nationwide basis. So the daily indicators of economic activity that we have available for China actually line up pretty well with that kind of ebb and flow, the tightening and loosening of the public health restrictions. If you look at this chart, you can see the low of economic activity is very clearly in February. Things improved quite significantly in March when the restrictions are loosened. There's kind of a plateau in April when things tighten back up again. But in May, there's very noticeable upward move again. And now a lot of these indicators are, if not completely normal, much closer to kind of a normal range. So it seems pretty clear that by this point in China, the public health measures aimed at containing the pandemic are no longer the main constraint on economic activity. So what's important now is to understand how much the economic fundamentals have been changed by this extended lockdown and how the economic policy response is playing out. So let's start with policy. The policy response has been complicated, I guess it's fair to say. The response has gone through really several stages, and the leadership, I think, has kind of continually updated and revised their understanding of what was going on, which, fair enough, this is an unprecedented situation, and they were thinking on the fly. So the initial response that we saw in February was quite conservative. I think it was really clear that policymakers' instincts were to try to stay as much as possible on the policy trajectory that they had already decided on back in 2019. Basically, their idea was, let's get the economy back to normal as quickly as possible, and then just go back to business as usual. Once other major economies started going into lockdown, though, it became clear that business as usual was not going to return quickly. China knew that it had to deal not only with the effect of shutting down its own economy for several weeks, but with the loss of global demand from other countries doing the same thing. The result is that by March and April, we saw a definite change in tone. The policy response became more aggressive. There's more easing of monetary policy, and more deployment of fiscal policy. So let's just go through here some of the things that they've done. There was a second round of interest rate cuts in April. The size was increased to 20 basis points across the various policy rates, compared to 10 basis points in the first round of rate cuts. Obviously, that's still a much smaller scale of rate cuts that we've seen in other major economies, but it's significant. In China, they regulate not just the price of credit, but also the quantity of credit. And so tracking credit growth is a significant indicator. Here, there's been a pretty notable acceleration. Credit growth is now running about 12% year on year in April, up from about 10% at the end of 2019. We think it's headed to about 14% growth this year. That'd be a similar magnitude of acceleration to what we saw happen in the last big stimulus cycle in 2015, 2016. It's pretty significant, but again, it's not a repeat of the mega stimulus kind of response that we saw in 2008, 2009. In terms of formal fiscal policy, actually it looks pretty conservative. So the budget deficit is, of course, expanding. There's been a lot of attention given to the fact that the budget deficit ratio to GDP is being allowed to go past 3% of GDP, which is sort of an informal target that they've observed for a long time. So it's targeted at 3.6% of GDP this year. But that, it's only about a 1% increase, and even, accounting for, even if you look at a kind of broader range of accounting for the budget, there's still not a very significant boost. Where we're seeing more effort is on the off-budget side, particularly in the local government projects for infrastructure. So the special purpose bonds, which are the funding instrument that China now uses for these projects, have been given a quota of 3.75 trillion renminbi for this year, which is a pretty significant increase from the roughly 2 trillion that was in last year. So that's a boost of about 1.6% of GDP off budget. So if you put the on and off budget together, it's a fiscal stimulus of around 2.5 to 3% of GDP. That's not nothing, but and it's certainly pretty significant compared to what we thought was going to happen at the beginning of this year. But it's certainly a much smaller response than China deployed during the global financial crisis, and it's much smaller than what a lot of other major economies have done in response to the pandemic, where you've seen packages that are, often 10% of GDP or more. So what's the reason for this? And fundamentally, I think it's because policymakers in China and policymakers elsewhere, particularly the US, really learned the opposite lessons from the last crisis. So in 2008, China went big, really big, and they spent the last decade essentially trying to clean up the mess that they created as a result of going so big. So the current crop of policymakers that are in power now in Beijing have lessened that you really don't want to overreact to crises, because it can create more problems for you down the road. The US, by contrast, didn't go big enough in 2008, and they've spent the last decade trying to clean up the mess that created. So I think a lot of officials in the US learned the lesson that overreacting to crises is better than underreacting. So they're really in a very different mindset in China, I think, than in a lot of other countries. So China is, is definitely trying to deliver support to the economy. They want to keep growth going. They just want to do that in a way that doesn't repeat the problems that they created for themselves using the mega stimulus approach. And it's a tricky balance, to be sure, and I think their judgment of where the right balance is still evolving, and they're still trying to figure it out. One thing that is significant is that leadership decided not to set an annual target for GDP growth this year. And I think that means that they don't want to get trapped into being forced to do a lot of stimulus in order to meet an artificial target. They really don't know what's going to happen with the economy, and they want to leave themselves more room to maneuver. But the fact that they didn't set a growth target, as the officials made very clear, is not a sign that they don't care about growth. It's just an indicator of the constraints that they're under here. So we want to look now at how different parts of the economy are responding to this policy package. Manufacturing obviously is key for China. And the numbers from the manufacturing sector after the lockdown lifted were actually pretty good. There's pretty rapid recovery in industrial activity. And I think this reflects the fact that it was not too difficult for most factories, most companies to return to normal operations once they'd figured out how to administer the right health precautions, and once the travel restrictions that were keeping workers from their posts had been removed. The issue, as you can see in this chart, I think, is that output of goods seems to be recovering faster than the actual demand from goods, from either consumer spending or corporate investment. So I think there's a risk that this very fast initial rebound may not be sustainable. A big risk, a big issue really, is that exports are almost certain to take a huge hit in coming months, just as the result of the US, Europe, other major economies going into lockdown. We don't have definitive numbers for global trade yet because it's still kind of early in the year, but the World Trade Organization is forecasting that world trade will fall by anywhere from 15 to this year. China, largest exporters, its export growth is usually pretty close to the growth of world trades. I think we're definitely looking at a very substantial decline in China's exports this year. It hasn't shown numbers yet, but really I think that's just a matter. Another thing that's worth keeping in mind is that the high tariffs that the US has imposed on Chinese goods have not gone away. The provisional trade agreement back in January left a lot of those in place, and it's a continuing issue for Chinese exporters, particularly given this contraction in demand, and we've already seen a substantial decline in the share of US exports coming from China. So I think as this shock to global trade starts to show up more clearly in the data in the next couple of months, it's quite likely that initial bounce in manufacturing we saw in China is going to get pulled back down. You can see that, given this chart from the PMI survey, that output is running ahead both of where domestic orders and export orders are coming. And given this plunge in external demand, the hopes for China's recovery are really going to have to be pinned on domestic demand. So that is the key question. And since China's an investment-driven economy, I think the most important component of domestic demand that we need to look at is really investment. Here, the early indications are that real estate and infrastructure investment are recovering faster than manufacturing investment, which is mostly private sector. And this makes sense because those are the two sectors that are most responsive to economic policy stimulus. In terms of real estate, we've got a government that, for the last couple of years has delivered pretty strong rhetoric against housing speculation, has made a priority of controlling housing price increases. But when you look at what's actually happening in terms of policy right now, it's pretty supportive. PBOC is cutting interest rates. Those changes in policy interest rates are in fact flowing through into changes in actual mortgage rates charged in the market. And in fact, a lot of the increase in mortgage rates that happened last year has already been reversed. Lower rates are good for housing. It's that simple. Housing prices also seem to be holding up on the data so far. And we take that as a sign that the lockdown did not really damage sentiment in the housing market too much. And housing sales, were definitely affected by the lockdown measures, as it's kind of an in-person transaction, difficult to complete online. But now that the lockdowns have been mostly lifted, property sales are coming back pretty quickly. I think actually they're lagging a little bit in the big cities, which probably have stricter measures in the rest of the country. By April, they were already kind of almost back to zero growth, so kind of a normal level. I don't think we should expect a huge surge in housing sales. The housing market in China is pretty mature, it's pretty saturated, but I think it's pretty plausible that we're going to get, positive growth in housing sales for the rest of the year, and that would be pretty welcome. And the steel market in particular seems to be clearly pricing in a coming rebound of demand after getting over the kind of the initial shock from the coronavirus lockdown. So another thing that's driving this optimism in steel is infrastructure, which people are expecting to rebound quite strongly given that big bump in bond issuance. We think that infrastructure investments, probably on track to grow about 10% over the full year, given that, of course, the numbers are down a lot in the beginning of the year, along with everything else. You're going to see, peak monthly growth rates of infrastructure investment of around 15 to 20%. A risk to that infrastructure rebound, though, is the fact that local governments are really squeezed financially. The lockdown has led to a huge loss of government revenues. The funds that are being raised to officially to be used for infrastructure may have to be diverted in part into government budgets just to keep things running. So there's a kind of a fiscal constraint on infrastructure spending, and that's one of the reasons why we think growth is going to be around 10% for the full year instead of say 20 or 30% as it was in previous cycles. So outside of those two very policy-tied sectors of real estate and infrastructure, the outlook for investment spending is, I would say, much less positive. The collapse in corporate profitability during the lockdown has been so severe that it just doesn't make a lot of sense for private companies to invest in a lot of additional capacity right now. The framework that we use to look at the investment cycle is basically to look at the relationship between the return on capital and the cost of capital. The decline in profitability has pushed down the cost of capital very severely. The cost of capital has also come down thanks to interest rate cuts, but not that much. So right now, the case for new investment is not that strong. And of course, there's a tremendous amount of uncertainty, particularly about the global situation, but also about domestic demand. So it is possible that that the private sector capex comes back if the economy normalizes, profitability starts to get more normal. You have another couple of rounds of rate cuts, which we think are likely this year. So the return on capital versus cost of capital trade-off could start to look quite a bit more positive towards the end of the year. But I think this is something that's basically going to take time. And it does involve, I think, a fair bit of companies waiting to see how things turn out before really committing to investment. So again, so any recovery, I think, in private sector investment is likely to take several months to play out. Finally, if we're going to look at domestic demand, we cannot neglect the Chinese consumer, of course. We know that retail and other consumer services were really the biggest victims of the COVID-19 lockdowns. And as those lockdowns have eased in March and April, we have seen things start to recover. Online retail sales, notably, are almost back to previous growth rates already. There is some high-frequency data available for restaurants in May that shows quite a bit more of a pickup, not quite to normal levels yet, but definitely on the trajectory. So again, that's these kind of supply side restrictions on how much consumption people can actually do are starting to disappear. So the real question is now a demand side question. How much is consumer spending going to be permanently affected by the economic losses that households suffered during the lockdown? The government, of course, is officially quite optimistic about this. The urban surveyed unemployment rate is increased by only about 1%. It's been hovering around 6% for the last couple of months. Given that China has an urban employed population of 400 some million people, kind of 1% increase in the unemployment rate implies job losses of around 3 to 4 million people. Given the scale of unemployment that we've seen in other countries that have gone into the lockdown, it would be very, very surprising if this were actually true in the Chinese case, and it almost certainly is not true. The data that's available on the rural migrant workers, for instance, show that there were at least temporary job losses of 30 to 40 million people during the first quarter when the lockdown was at their height. We've done some fairly detailed work looking at the state of individual sectors, and our conclusion is that there are anywhere from 60 to 100 million people out of work during March and April, which is equivalent to 10 to 20% of non-farm employment, basically. And these numbers are pretty similar with what other analysts who have also looked at this question have come up with. So I do think that fundamentally China's not that different from what other countries have gone to. It has seen very substantial job losses of at least a temporary nature. What's different in China is that the social safety net is quite weak, and in particular the protections for unemployment are very limited. So in normal times, a very small number of people in China are entitled to get unemployment benefits. Official numbers was that was 2.28 million people at the end of 2019, and the government disclosed that that figure had risen to a total of 2.3 million people as of the end of Q1, so a net increase of only 20,000 over that 3-month period in which tens of millions of people lost their jobs. So basically, almost none of those people who did lose jobs, were able to get on public benefits. There has been, different kinds of support programs that are, not called unemployment insurance. There's been one-off subsidies of different kinds organized by central and local governments. And the government has promised publicly several times that the eligibility for employment benefits is going to be expanded. So maybe in the future, there will be more people will become eligible and get more of this support. But we can say that so far, very little of China's fiscal response to the pandemic has gone into offsetting the enormous hit to household income that occurred. So I'd say, at the very least, there's, kind of a lot of uncertainty about how consumer demand is going to recover given this impact. Of course, it's also true that these job losses were concentrated, as again in other countries, people in kind of the lower distribution. So the upper classes may be doing better, and that's probably one of the factors that's going to help support the housing market. So to wrap all of that up, basically the situation in China is that it has experienced the greatest shock to economic growth since the global financial crisis of 2008, but the policy response that it is deploying to get out of that growth shock is much smaller, both in comparison to what it did in 2008 and in comparison to what other countries are doing in 2020. The policy response is not trivial, it's for real, and the policy sensitive sectors of real estate and infrastructure are certainly going to accelerate this year. Manufacturing, however, is almost certain to take a big hit from the collapse in global trade, and private sector investment and household consumption are getting much less direct support. So overall, I think that points to a pattern of a staggered and uneven recovery, excuse me, rather than a quick return to normal. All right, and that's it for me. And thanks, Amy.